5 common stock investing mistakes made by beginners. It's the stuff of nightmares to make investment mistakes that will wipe out your life savings. Stories in movies and books often portray investing as riskier than betting on red in a casino. However, knowing a few simple rules can save time and frustration and avoid making the most prevalent investing mistakes. In today's video, we'll discuss 5 common stock investing mistakes inexperienced investors make. Number 5. Avoiding necessary financial preparations like debt repayment. Investing is an activity that everyone ought to do, but they shouldn't start doing it until their more fundamental financial matters are resolved. According to the 50-30-20 rule, you should spend no more than 50% of your income on necessities such as food and housing costs, 30% on enjoyable things such as entertainment and clothing, and the remaining 20% on saving or investing. Instead of putting this 20% of your income toward investments, you should focus on achieving your other financial objectives, such as paying off your short-term debt and building an emergency savings fund. Having some money put away in savings is essential, which should be easy to get at in a hurry if you require. A recent survey found that 34% of Americans have no rainy day fund, leaving them without any financial protection if they become ill or lose their jobs. Most financial experts recommend having 3 to 6 months worth of expenses saved up. If you become seriously ill or lose your primary source of income, you can focus on getting better without being concerned on how you will continue to put food on the table. Number 4. You are putting all of your savings into investments. There's always the chance of losing money when investing. The value of your assets can go down and up. When the market is this unstable, it's not prudent to invest all your money. Never put up money you can't afford to lose when investing. This is one of the golden rules. That includes the rent for the following month, the money you've been saving for a down payment on a house, or the money you need to take a vacation the following month. Spend some time sitting down and drawing out a rough financial timetable for your future, including major purchases like homes, education or your kids' education, and retirement. It should help you estimate how much money you'll need and when you'll need it. Investments should be made toward any long-term monetary goal, even if it's further away than 5 years. When your cash need is further off in the future, you have more flexibility to take on greater investment risk. Number 3. You're choosing not to spread your investments out. It's tempting to put all your money into the newest stocks to make headlines, such as Zoom and Tesla. However, doing so exposes you to a high level of risk if something goes wrong at those companies and their stock prices drop. Instead, it would help if you work toward having a diversified portfolio. One of 2 approaches to achieving the goal of portfolio diversification is essential to avoid putting all of one's financial eggs in one basket. There is the question of which investment to make. Examples of asset classes include stocks, bonds, funds, exchange-traded funds, gold, and cash. It is prudent to diversify your investments between those that offer higher potential returns but carry a higher degree of risk, such as stocks, and those that offer lower potential returns but are more stable, such as bonds. Although diversification is beneficial when markets are behaving normally, it is beneficial because different asset classes react differently during market stress. For example, the stock market typically drops as the price of gold rises during a recession. The 5-25 rule suggests spreading your money across 5 distinct asset categories with no more than 25% allocated to any single asset. To further spread your investment risk, you can pick stocks from a wide range of industries by hand. Diversifying your holdings across several companies is the best way to protect your portfolio from suffering significant losses due to industry or country-specific financial events. If you're enjoying this video, please hit the like button and subscribe to our channel if you haven't yet to show us your support. Now let's continue. Number 2. A failure to conduct adequate research is another common mistake. Do your research to choose the best stocks for your portfolio. The history of the company, its projected future performance, and how it stacks up against the competition are all crucial pieces of information to have at your disposal. They will appear on a stock market under a ticker symbol, which we should check before anything else. Then you can check online to see where the stock is headed in general. You can see that Apple's stock price has increased over the past year and is selling for $113.85 per share. Number 1. Feeling driven purchasing and selling. It's simple to follow the crowd's lead after reading the news and doing what seems to be the popular thing to do. It typically occurs during financial crashes, when widespread panic among investors leads to frantic attempts to unload stock before its value plummets. On the flip side, it's simple to get swept up in the hype surrounding a company that's receiving a lot of press, and as a result, purchase shares of stock when they're at or near their highest price. Price fluctuations in the market are a fact of life. If you're interested in investing but lack the experience to know when to buy and sell, start with a small amount of money and gain some practice before committing your life savings. Well, that's all for today's video. Tell us in the comment section how this one was. I hope that you found this video interesting. If you want to see more videos like this, please consider subscribing for more. And don't forget to give comments and provide us with your valuable feedback. We'll see you in the next video with some more interesting facts and stories. And until then, stay tuned.